Joining us right now to talk about the markets and the Fed's next move is Mira Pandit. She is global market strategist at JP Morgan Asset Management. Also, Krishna Guha, who is vice chairman of Evercore ISI and head of the global policy and central bank strategy team. Why don't we start with you, Krishna, just because this is kind of your wheelhouse. You agree with what we're just hearing, this idea that they'll skip in June, hike in July, and maybe that's where we see things with the central bank? Is that your opinion, too?
Yeah, so we have consistently said all the way through that the Fed is not going to hike in June. Now, that was a view that was very much challenged by market pricing not very long ago, but the market seems to have come round to this thesis. Fed is not hiking in June. The price for not hiking in June and keeping the committee together will be to make July live and probably with some kind of a lean or default to hike again in July unless the data between now and then provides some additional reassurance that the economy is cooling in the way the Fed wants to see. So I think the Fed will signal a July hike is more likely than not. I personally have my own forecast under review. I don't yet have a hike in July. I think the economy is cooling off. The question is whether the data will arrive in time so the Fed can skip again in July, come and have a look again in September and conclude it actually doesn't have to do more. But for sure, July is the one that is in play, not June.
Mira, you think that there'd be limited impact if they were to actually raise rates again in July, that at this point the stuff that is really seeing inflation stick is not things that rate hikes would really work on?
Ultimately, by the time we get to July, they're going to have two CPI prints in hand, which if we think about May and June of last year, were very hot. So on a year-over-year basis, that could bring inflation below 4% by the middle of the summer. And if that is the case, they'll have the data in hand to actually pause for sure. But I'd also say if they wanted to hike at this point, if we think about where inflation is the most sticky, services and particularly in rents, there's not that much that additional hikes can really do about that because services are not all that interest rate sensitive. If we see a hike, you're not going to cancel your dinner reservation. And if we think about rents, of course, they are very interest rate sensitive, but we're in a period of time where there's not a lot of housing supply. If you have a mortgage at 3%, you're not going to want to move out of your house for a 7% mortgage. So actually, somewhat perversely, the higher mortgage rates go, the more pressure that puts on rents because it forces people into the rental market. So at this point, I'm not sure that there's that added benefit for additional hikes.
How's the market react, though? You may not cancel your dinner reservations, but what happens with your stock market portfolio?
Well, interestingly, basically since the May FOMC meeting, we've seen a wild swing in expectations for where the Fed funds rate goes, from no hike in June to hike in June, back to no hike in June, but hike in July. And all throughout this period, equity markets have been surprisingly resilient. They haven't really reacted to a lot of these shifts. And a lot of people were saying once those cuts get priced out at the end of the year, we're going to see more equity market volatility, and we just haven't seen that. Ultimately, if we think about what's going on in the equity markets, we've had such resiliency yet again within profits, within economic data, and that has really prevented a broader correction.
Well, I would also say, look, if the market is kind of priced in the idea that we're going to potentially see a rate hike in July, if we don't get it, does the market move substantially higher or not?
I think the market will remain relatively range-bound. I don't think that there is a foregone conclusion in terms of the direction of travel, but I think that if we compare our situation to last year, when you continued to see expectations for rates move higher and the S&P continued to move lower, now we've hit more of a stable point where the range of outcomes from the Fed is more limited, and therefore the range from a market perspective is more limited as well.
Krishna, we just talked about Goldman. Jan Hatzius saying that he's bringing down his odds of a recession to 25%. Where do you put the odds?
So I still have a mild recession as my baseline case, a bit over 50%, a softish landing, a bit under 50%. I think the economics can work. I think you can, in principle, cool off inflation without a large increase in unemployment, which is the sort of basic, test for whether we get a recession or not. The issue for me is that the calibration is just so hard, right? The Fed is trying to judge how much tightening is enough, and of course, this all works with a time lag, so there's a lot still left in the pipeline. You've also got this uncertain, but I think still significant amount of credit tightening coming through the pipeline. Now, the current momentum in the data still looks pretty good on most measures, certainly payrolls. But I think the odds that you can stick this landing aren't above 50%. But certainly, I would say the possibility of getting a softish landing is not bad, considering what we've been going through, considering the task of getting inflation down. And there are good reasons to think that if we get a recession, it'll be on the mild side.
Like what?
I would be focused more around the turn of the year. Look, we still have to run down some of the rest of the savings balances, and the momentum in payrolls and in real incomes after inflation, that's going to carry us, I think, in the near term with decent momentum. But it's as my colleague Ed Hyman points out, it's always good until it isn't in terms of the onset of recession. So yes, decent momentum in the economy. Yes, plausible that we could get away without a recession. I would still soberly say recession is a bit more likely than not on that 12-month type view.